Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about the fair value price of Palantir Technologies PLTR stock, which is what the stock should be trading at right now, and we're going to estimate this statistic and metric based off of their free cash flows. Today we are going to be estimating the intrinsic value of Palantir Technologies, ticker symbol PLTR. If you didn't already know, the PLTR stock price currently trades at $12.71. The low-end price target by analysts is $15 per share. The average price consensus among analysts is $21.06, and the high-end price target is $25.30 for the beginning of 2023. So these are 12-month stock price targets for the PLTR stock. Palantir is a big data and analytics company that creates platforms for both government clients as well as commercial agencies. So we are going to calculate Palantir's intrinsic value based upon their discounted future free cash flows by using the DCF model of calculating intrinsic value, also known as the discounted free cash flow model. We have done this model multiple times on my channel for multiple different stocks, but these metrics tend to change throughout time, so I want to keep you all updated on what Palantir actually is worth right now. We need to calculate Palantir's value based off of their present value of all the cash that they will generate in the future. This is why we're going to use the DCF or discounted free cash flow model, and we're going to use this valuation to calculate the stock price and what the stock should be trading at. The reason we would want to do this is because if the intrinsic and fair value is above the stock's current stock price, that means the stock is going to stop falling, which means that the market will eventually adjust to this intrinsic value. Now, for the DCF model, we're going to break it down in two stages. In the first stage, it's going to be their high growth period, and then for the second stage, it's going to be their steady growth period. And we have to get estimates from both of these using the projection of the next 10 years. To do this, we are going to use analyst estimates when we can, and then we are just going to estimate out their future free cash flows if we don't have any analysts' projections or forecasts. We're also going to make a few assumptions, such as the dollars today is more valuable than dollars in the future, and this should be common knowledge because of inflation. As time progresses and as inflation takes a hold of money, it takes away purchasing power and buying power from the value of a dollar bill, so clearly money now is more valuable than money in the future. So we are going to use this to our advantage to calculate the stock's current present value. Now, because inflation has been absolutely insane by around 6%, that is what we're going to discount the present value free cash flows according to. We're going to use 6.2% instead of using the regular inflation rate of around 2% annually. So we are calculating literally the worst case scenario. The reason why we would want to calculate the worst case scenario is because once we understand that this is the worst that the stock could possibly be worth, we know that the future value of the stock is either going to equate to this or it's going to be much more, and we could be pleasantly surprised. So to do this, we are going to use the following metrics. We're going to use the leverage free cash flows in millions of dollars. We're going to use their growth rate estimates for their cash flows, either according to analysts or our own forecasts, and then we're going to use the present value of the money discounted at 6.2%. And as you can see here, we have the data from 2022 projected all the way out until 2031. For our last assumption, we're going to estimate that as the company continuously grows, it's going to be harder for them to obtain future free cash flows at a substantial growth rate. And this is mainly due to the law of large numbers, because it's going to be harder for them to increase on a percentage basis the more free cash flows that they have actually acquired, instead of a small company that can easily increase their revenues and free cash flows by a percentage basis year over year. And that's why we can start with estimates of 13.67 from 2026 and end up with only an increase of 3.93% by 2031. Luckily, Simply Wall Street has already calculated the PVCF, which equates to $6.3 billion, and we are going to use this as Palantir's present value of a 10-year free cash flow. Once this is done, we can use this metric to calculate the terminal value of the company right now, where all future free cash flows are discounted over a 10-year period. Now again, this is going to be a very conservative growth estimate rate, and we're also going to borrow from the 5-year and 10-year government treasury bond of around 2% to estimate future growth, all while discounting this at a percentage of 6.2%, and those are going to be our major assumptions. Right here, you can see the formulas that we have calculated calculated, but instead of going through all of this boring math, they have already given us the answer right here of $30 billion for the terminal value. Once we have calculated the terminal value, which is $30 billion, once we have calculated the terminal value, we can now calculate the present value of terminal value, also known as PVTV. We are going to use this TV metric and we're going to insert it into the new formula where TV pops up as a variable, and then once we do that and we work out the math, we can see that the present value of terminal value is $17 billion. And we can use this PVTV to calculate the intrinsic value of the stock by dividing this by the total number of outstanding shares. And once we do that, we get a value of $11.41, while the current stock price trades at around $12.71. This means that we could have strong support at $11.41 because according to these statistics and the assumptions that we made, this is the actual fair value or intrinsic value of this stock. So for the stock to trade below this, one, it would be a fantastic deal, and two, eventually the market will cause it to rise back up to $11.41 at minimum, because remember, these are conservative estimates on the very low end. It also doesn't mean that the current stock price is a bad value, even though technically it's about 11.3% above their fair value estimate. We have to calculate some variance here of around 20%, so anything in this yellow Goldilocks zone technically also counts as their overall fair value. And this Goldilocks zone extends all the way out past $13 per share, and remember, these are low-end price targets, so it would be very surprising for the PLTR stock price to drop below $11.41. Now, that is not to say that the stock price cannot drop below $11.41, however, it would be unlikely, and if it does, we can almost count on it receiving and going back to $11.41 within a couple months. I also want to say that we used an extremely heavy discounted rate of around 6.2%. That is extremely heavy. Normally, we would want to use anything from around 4% to 2%, so this is a very, very conservative estimate, and we should definitely keep that in mind. If you don't agree with these results, feel free to perform the calculation yourselves and double check the math of me as well as Simply Wall Street. I also want to add that the discounted free cash flow model does not consider the possibility of cyclical transitionings from growth stocks to value stocks, or the company's future capital requirements or future expenditures. We also calculated this off of a leveraged beta of 0.971. So we got this beta from using the data and other betas from the industry average of other comparable companies in a very similar or at least the same sector. The last caveat is, although the valuation of this company is extremely important, the DCF model is not the end-all be-all, and it is not law. This can be wrong. The calculations and metrics change in the DCF depending on what assumptions that you actually plug into the formula. I have two other videos where we have calculated the DCF model using different assumptions, as well as the LA Stevens model, which also gives us their fair value and intrinsic value for Palantir Technologies, and we got price targets anywhere from around $17 all the way until $30. A great example of this is Morningstar, which is a very reputable institution, and they still say that Palantir's PLTR stock price has a fair value, or at least a fair value estimate, of $31 per share, and right now the stock is extremely undervalued, according to Morningstar. They even have a 5-star rating on Palantir Technologies, and they are extremely bullish for Palantir's future. So it does depend what assumptions you make while calculating the intrinsic values of a stock. I just wanted to give you the low-end price prediction and the low-end fair value targets for Palantir, which can signal us when the bottom of this stock actually is, or at least where the bottom of this stock actually is. That, again, is not to say that it cannot drop below the fair value estimate, but it's very safe to assume that this could be a bottom, and if it does break this bottom, it's most likely going to recover back up to this price point at some time or another. But I want to hear your thoughts. Comment your thoughts down below. Remember to smash the like button on this video right now, subscribe if you are new, and I will see you in the next YT video.